Data shows that 53% of companies backed by venture capital funds return less than what VCs invested in them. Only 12% of VC-backed companies return at least 5x of the capital invested. This is 1 in 9 companies. Now, that does not mean that the majority of the companies which do not return a multiple of the capital invested are bad businesses. But without additional funding and really misaligned ownership and incentive structure, many of these businesses end up being written off or shut down over time. Welcome to the world of VC orphans. In this episode, we explore investor-abandoned companies, common reasons they exist, and how to get the investors and founders to exit these businesses. Intro. What's up, everybody? Welcome to my channel. I'm Alexej, an investor and an entrepreneur. Before starting my own holding company with several businesses launched and one acquired, I worked for many years at a family office investing in tech companies and later at a private equity fund acquiring businesses completely. In the last 10 years of being an investor and an operator, I saw quite a few companies which were neglected by investors and decided to share with you my insights into the VC orphans. If you're new to this channel, welcome. I drop an episode once a week with insights from companies we work with, venture-backed, private equity-owned, or bootstrapped, all around the world. In this episode, I'm going to share with you my insights into VC orphans, why they exist, and share 8 top tips for buying a VC orphan. If you're excited to dive into the first strategy, go ahead and press that like button for the YouTube algorithm. We put a lot of energy and sweat into these videos, so that algorithm boost really helps us. So, to start, what is a VC orphan? Data shows that more than half of SaaS businesses in the Series A and Series B stage grow less than 35% annually. Investors, however, look for at least 100% growth rates annually. This goes back to the concept of T2D3, coined in 2015 by Neeraj Agrawal, who is a partner at Battery Ventures in Boston. To reach unicorn status of 1 billion valuation or $100 million ARR, assuming 10x revenue multiple, a company should triple in revenue in the first 2 years and then double in revenue every year, 3 years after that. The majority of VC-backed companies have a fraction of the expected growth though. Yet they managed to raise at a very high valuation, either because the overall market sentiment was very bullish at the time they raised, or because they were riding on some amazing industry trend, or of course both. Without the market sentiment being there and with them growing much less or not growing at all, no typical VC wants to fund them anymore. And founders are stuck on that big pref stack without the outlook of making any money. In other terms, they become VC orphans. In short, VC orphans are startups that, despite initial promise, haven't achieved the hypergrowth or substantial returns the investors expected. But what exactly causes startups to become VC orphans? Let's consider each of the 4 reasons. So the first reason, underperformance, in this context does not even mean lack of product market fit or lack of revenue, but it's just not living up to the expectations of the VC and not living up to the valuation the business raised funding at. This lack of progress and achievement leads to a reduction or complete halt in funding, compelling startups to operate without the essential capital required for their envisioned growth or, in some cases, survival. Examples can be seen in a lot of industries which suddenly had a big influx of competitors coming in, such as the restaurant booking space or certain horizontal or vertical software market space. Now, if you learned something from that video already, and if you're still watching this, please leave a yes in the comment section below. Now, the second common reason why VC orphans exist is a shift in the focus of the venture capital investor. Venture capital is one of the asset classes where it's all about having blockbusters in your portfolio. To hit the 20% to 30% returns VC promise to their investors, the LPs, the VCs need to focus on the winners in their portfolio. Given the power law in VC, it's all about doubling down on the company which can deliver that 100x return, thus returning the fund. This quest often leads to a relocation of resources towards startups demonstrating stronger growth, sidelining those with steady but less spectacular performance. Consequently, startups that do not exhibit the hypergrowth necessary to captivate investor interest find themselves overshadowed and underfunded despite maintaining a solid business foundation. Now, position 3, market conditions. The availability of venture capital is heavily influenced by broad economic and ever-changing market conditions. Periods of economic prosperity see a lot of venture funding, but this can quickly retract during economic downturns or market instabilities. Startups that receive generous funding in hyped times, such as during 2020 or 2021, may suddenly encounter a lack of investment in the years of recession, as the VC retract the commitments and respond to changing economic landscapes. Put simply, when the market tightens up, so do VC wallets. Now, the other reason is changes in the VC, completely beyond the control of the startup. Nobody talks about it, but venture capitalists are not staying at the fund their whole life. If you're lucky and one of the founding partners led the investment into your company, the chances that that partner leaves are slim. However, with firms becoming quite large and more than 50% of the deals are being done by non-partner level investment professionals, there is a high chance of the person leading the investment potentially ending up leaving the fund and going to another fund or launching their own fund. This happened to Matteo Grassi. He raised 3.5 million pre-seed from Excel, 20 VC, Seed Camp, and his main deal at Excel left to join another firm. Now, to find out more, check out the link below to our SaaS Minds podcast. The episode is called The Dangers of VC Funding in SaaS. Now, we've unpacked what a VC orphan is and 4 common reasons for their existence. So let's move on to the next crucial question. How can you seize opportunity to rejuvenate these ventures? So in the next part of the video, I provide you with 8 strategic tips for acquiring a VC orphan business and steering it towards success. Now, the first step out of 8 steps on how to acquire VC orphan is sourcing opportunities. To uncover VC orphan acquisition opportunities, it's a very different approach to your usual VC approach. There are no demo days or pitch events for VC orphans. Instead, it's much more about looking into companies which have raised before, but not raised for at least 2 or 3 years, and opportunistically approaching those companies. There's a lot of data out there that if a company has not raised for at least 24 months, the chances of the company either growing or raising again are much smaller than companies who raise every 6 to 18 months. This is just a proxy you can apply if you sift through thousands and thousands of rows in different databases providing this type of information. PitchBook, Merger Market, CB Insights, the list goes on. The second approach is just calling up VC funds in your network and being blunt if they think they are and have portfolio companies where it could make sense to initiate an acquisition discussion, but stating that it will most likely be not a home run for them. But it will still be better than a write-off for them, which is ultimately what might happen if the business doesn't get any funding and nobody comes along to save it. Most of the players in the VC orphan game are ex-VCs or distressed asset investors, turnaround experts who know the market quite well. However, with so many opportunities out there, it does not mean you cannot do it. While there are many potential VC orphans out there, the situation where you can successfully acquire that business and have all parties agree is very rare. So make other people aware of you looking for VC orphans and hoping, and you can maybe get some referral to a situation out there, which is a route you should consider as well. Many SaaS aggregators are on the hunt for VC orphans, as well as also healthy bootstrap businesses. If you want to learn more about the players in the space, check out the link below listing all the aggregators in the software space and the example of companies they acquired. Now, the second step to acquire a VC orphan well is to deep dive into the business. Before considering an acquisition, you must gain a thorough understanding of the venture orphan's business model, financial health, and the operational challenges it faces. I can make 20 hours of video content on just how to acquire business, but in short, you need to do your due diligence. More importantly, you need to understand how big that business can get and what are the main reasons limiting the potential right now and whether you can unlock it. As with any other business, be ready to do a proper digital due diligence, legal due diligence, financial due diligence, and do not forget the technical due diligence, including software quality review to avoid surprises around code quality and a huge technical debt load. Some of the red flags might be also your opportunity to fix that business, but you should definitely be aware of all that before you acquire that business. If you have skills or data or distribution which can provide the superpowers to that orphan business, that might be the reason why you want to acquire that business. Negotiation and transparency is the third step out of the 8 steps to acquire VC orphan. Effective negotiation coupled with transparency is key to acquiring an investor-abandoned business. It involves clear communication about the acquisition and potential benefits for all parties, including founders, equity holders, and if they have debt, also debt holders. It's a balance between you disclosing everything you want to do to the business, such as operational challenges and restructuring and streamlining the team, and being understanding with the founders. There is data out there showing that for VCs, selling out of their underperformers instead of letting them go to zero over time can add another 5% to the overall fund performance. So in going from 15% IRR to 20% IRR or 20% IRR to 25% IRR. Why are not more funds doing it? Well, there is also data suggesting that focusing on your winners and doubling down on them provides a similar increase in overall fund performance. And it's probably more fun to help the winners rather than get into the messy weeds and emotional work of VC orphans. On that note, if you want to understand how fund returns improve, you can download a financial model in the link below. You can simulate how your fund returns improve if you eliminate some of the underperformance from your portfolio. Now, in the fourth position, strategic deal structuring. Firstly, there is a question of equity retention and more often an equity reset. It does not make sense to have all the 1x or sometimes 2x liquidation clauses associated with preference shares given to investors. In this scenario, the founder won't make any money from the exit. The founder needs to have more incentives to keep going than an equity hire scenario or a scenario where he or she just continue to pay themselves salary before letting the business shut down. If there's debt involved, there's some sort of debt resolution which needs to happen as well. Addressing the founder's personally guaranteed debt and venture debt is critical. Ensuring these obligations are managed or renegotiated can prevent the financial ruin of the founders, making the acquisition more palatable. Finally, operational efficiency measures have to be communicated upfront. Implementing operational cuts to achieve a profitable run rate is essential, but it's something most founders will be against. Thus, it's critical to be transparent that this will need to happen and that everybody needs to be okay with that. Timing and speed are crucial as a fifth step. In the acquisition of VC orphans, time is of essence. Moving quickly through the due diligence process, preparing offers promptly, and engaging in efficient negotiations are critical to capitalize on opportunities before the company's situation deteriorates or competition increases. Swift action not only positions you as a serious buyer, but also can secure better terms and prevent the loss of value in the target company, making speed a strategic advantage in the acquisition process. Now, ethical considerations is another key step. Acquiring a VC orphan business is not just a financial transaction. It's a process deeply intertwined with ethical considerations. Potential acquirers must navigate the delicate balance of pursuing a deal without negatively impacting the personal finances and livelihoods of the founders and their teams. Ethical diligence involves ensuring that the acquisition does not unduly disrupt existing agreements or exacerbate the challenges faced by the company's original creators. Now, in position 7, founder involvement. In any acquisition, especially with VC orphans, the question of how to involve the founders post-deal is critical. Whether there's one founder or a team, their knowledge of the business, its culture, and its customer base is deeply valuable. Deciding on their roles requires a nuanced approach. Sometimes it's beneficial for them to stay and help with the transition, and other times the company might need to move forward in a new direction. Having your contract ready with the transition period agreed and potential earnouts, but also non-compete clauses is critical. Now, before I cover my last piece of advice, please hit that like button. So last but not least, on position 8, drum roll please, learning from the process. Every attempt to acquire a VC orphan, whether successful or not, is a learning opportunity. Reflecting on the process allows acquirers to understand better the complexities involved in such transactions. Learning from each experience can refine approaches to future acquisitions, making them more efficient and effective. To finish off our episode on VC orphans, fueled at the outset by significant funding, VC orphans fall short of critical performance benchmarks. Consequently, they find themselves at a crossroad. The company might be an interesting acquisition candidate, however for a much lower valuation than they raised money at. And given the pref stack, the founder would not make any money in this case. Or the company could continue to grow, but it's usually a very lonely and long battle uphill without anybody keen to invest more money, and with the founder potentially making more money by just starting a new business. In addition to traditional private equity funds, SaaS aggregators and secondaries funds who are happy with more modest returns than traditional VCs, there has been a rise of more dedicated orphan funds now. If you're interested to learn more on acquiring businesses, by the way, I did a video on 6 ways how to build a 100 million ARR business where I discussed the concepts of SaaS aggregators much more in depth. Feeling like you have a great understanding of VC orphans? In the last 6 months, we have worked with quite a few private equity funds and individuals looking to acquire VC orphan. If you need a hand in conducting the due diligence, please book a call with us in the link below and we can look at the performance of the business you're looking to acquire. If you own a business and you need help scaling it, we can help you execute on that. If you have a fellow investor, if you have a team member, if you're part of a Slack group, Telegram or WhatsApp group with other investors that could get value from this video, please share this video with them. I drop an episode like this with strategies and concepts for tech businesses once a week. Please hit that subscribe button and that bell icon so you'll get notified every single time I release an episode. Thank you for joining me on this journey. I'm Alexej and I will see you in the next episode.